We propose longing the Feb WTI Brent Differential. The international crude structure is weak, but we expect some short-term strength in the contract. We believe there is good risk-reward in going long here. Looking at the historical levels for these trading days in previous years, we can see that current levels are lower than in all years except for in 2020, which these prices are currently closing in on. The options volatility skew for Brent Futures show that players are willing to pay more for downside protection this week. WTI saw a weekly increase in call volatility, although it remains below the put option skew. This shows an increased willingness to pay a little more for upside risk. Looking to the CFTC, there was an increase in short positions in both Brent and WTI with lackluster global demand. The net positioning in WTI for money managers has dropped to such an extraordinarily short level that it may be primed for a squeeze, with fund managers sitting at a long-short ratio now below the 4th percentile for the past 10 years. It is also worth considering the closely correlated relationship between the dated Brent spreads and WTI Brent differentials due to the WTI Midland grade of crude setting the dated curve. There is continued interest in longing these spreads, which may translate for strength in the fizz diff. This is a contrarian trade, so we would recommend entering in small quantities until you catch the upward trend and a tight stop once support is seen. For more trade ideas like this, tune into our podcast The World of Oil Derivatives on YouTube, Spotify, and Apple.